Good evening, good afternoon, as it is applicable. I'm pleased to welcome you all here at the digital mini conference organized by CFA Society Pakistan. My name is Asim, and I'm president of CFA Society Pakistan and also the chief investment officer at MCBRA for Beef Savings, a local asset management firm. CFA Society Pakistan is a member society of CFA Institute, which administers the CFA program globally. CFA is globally recognized as gold standard in the investment management. CFA Society Pakistan is run by volunteers, and our objective is to work towards development of capital market and promote professional and ethical behavior in the capital markets. So today's topic, digital currencies, Bitcoin, cryptocurrencies, blockchain, have been gaining a lot of popularity, particularly in the past few months and weeks. And a lot of discussion is being held globally and in Pakistan alike about their future, their potential, how would the future look like, and especially with regards to the potential of cryptos and the blockchain technology and the digital currencies in the portfolio of investment assets. And when we look at several global firms have launched crypto-based funds, crypto-based portfolios as well. So that is, again, the debate is continuing on and about the future and the potential. But I think we have very good speakers for in the upcoming sessions to tell us about it more briefly and more detail. We have again 3 sessions organized in this conference. So first session we'll have it from several speakers who are going to talk about how the asset management firms are looking at and how the corporate portfolios are looking at these ones. Then we have another session where we will get a deep dive into crypto assets and digital and blockchain technology. And in the end, we will hear from our local regulators about their perspective and their approach towards the potential. Particularly interesting, several latest developments, especially it was heartening to know recently, you must have seen the news recently, that a local university, Lahore University of Management Sciences, LUMS, has also established a fund. And as per the news, they have received the funding for that in the form of Bitcoin, which had already appreciated by the time they had received and announced it. So heartening developments happening here. And that gave us the idea to consider this conference and have, again, while it takes time for cryptos or digital currencies to be formally accepted in Pakistan, at least we have a good perspective how these global firms and asset managers are looking at it. For this, I would like to especially welcome our speakers who have joined us here, especially Mr.
So I think, Ali, maybe you can continue.
Sure. So this, as Asim said, this is a very, very important topic and very exciting topic, especially given the times. A warm good morning to you from London, and to all my friends in Pakistan, a good evening. My name is Farid Khwaja. I'm the chairman of KASB Securities. I'll be moderating the first session of today's conference. Bitcoin topic is very dear to me. And my first interaction with on this topic was in 2011, when I was an analyst at Berenberg, the second oldest bank in Europe, and I wrote a report on this topic. And I remember back then, the price of Bitcoin jumped from 800 to 1,000, and the newspapers in Germany attributed that to the report which I published. Then over 2012 till 2016, I did a lot of meetings with institutional investors in the US and the UK, across Europe, explaining to them what is this all about. Then my second main interaction on this topic was in 2016. And at that time, I was CFO of one of the largest payment processing companies in Europe. And I met this startup called BitPay, which came to us. The CEO of the company, Tony Gillespie, came to us asking us to enable Bitcoin payments on our payment processing platform. Our assessment at that time was that this is too volatile, it's not properly regulated, and perhaps it's a bit too early for us to enable this on our platform because we were a highly regulated company in Europe. So this was in 2016. And it turns out that we were not fully correct. Since then, Bitcoin has reached $1 trillion market cap, which means that it's 3 times the size of Pakistan's GDP. And large funds, including BlackRock, Fidelity, the largest asset managers in the world, are investing in it. Some of the largest companies are investing in it. The biggest company in Bitcoin, which is doing a listing, Coinbase, its market cap is supposed to be bigger than $100 billion. Again, to put that in perspective, that's almost 2 times the size of Pakistan's total market cap. And many regulators are now even looking at launching their own digital currencies. And on the side of that, not only has digital currencies and tokens gained adoption and the price has gone up, but also academically, a lot of work has been done on it. The CFA Society has published a paper recently, and we will be hearing from the authors of those 2 papers after this session. Many universities in the US, including Princeton, are now teaching courses on this. And as Asim mentioned earlier, LUMS has recently received a grant of now $6 million from Blockstack, which is a New York-based company run by a Pakistani who is an alumnus of LUMS, my class fellow and friend, Munib Ali. So a lot is happening. And in this first session, we will be discussing that. And I'm delighted to have Chris Aruliah, who's the head of business development for Bitstamp, which is the largest regulated exchange in Europe, and Muhammed Yesilhark, who runs a fund which invests in crypto. And before that, Muhammad was the CIO, head of Europe for SECP Capital, and then he was the CIO of one of the largest European asset managers. Join us in the first panel. Chris and Muhammad, thank you for joining us.
Thank you, Ali. Pleasure to be here.
The reason why I'm really excited to have you guys on this is that, Chris, you run, you're in the management team of a regulated and large exchange in Europe. So when I buy Bitcoin on Revolut, which a lot of people on this call would be familiar with Revolut, the digital bank. So when I do that on Revolut, that's actually your exchange, which is enabling that. So you are dealing with institutions, you're dealing with the regulator, you're dealing with individuals. And I would love to get your perspective on how are you doing all of that? And then I'll go over to Muhammad, because he has managed billions of dollars in capital in the regulated market, in traditional assets. And he was a client of mine, and I remember him being as one of the smartest investors in the space, somebody who did not go with the flow, somebody who was brave enough to take contrarian bets. And often he was skeptical of where the crowd was going. I would love to get his view on why is he and why are other people investing institutional capital in it. So let me start with you, Chris. Tell us a bit about Bitstamp. And you say that you're a regulated exchange. How does the regulation work on it? And then I'll come to you and ask you, what are you seeing from institutions, and how are institutions investing on it, and how are they getting over this point about KYC, compliance, regulation? So over to you.
Yeah. Okay, Ali, thank you very much. So yeah, just to give a brief introduction to Bitstamp and some history which might help with answering that question. Bitstamp's been in operation since 2011. It's the original Bitcoin exchange. So when Bitcoin was in its infancy in the early days, Bitstamp was a startup that served the market. The miners would come and deposit their Bitcoin with Bitstamp. And since then, obviously, Bitstamp has grown to be one of the largest exchanges in the world. We are one of the largest for liquidity and volume, and we serve, as you mentioned, Ali, a number of institutional clients around the world. Those institutions are banks, they are funds, they are corporations, and through the journey from being a startup to today, we've gone through a number of phases, and one of those phases is that we adapted very early on in our life as an exchange to adopting the same practices that happen in banks, such as KYC and AML. And we did that even before the regulator required us to do so, or even we were required to do. So in some ways, we've led regulation in Europe as being the largest European exchange. We are regulated in Luxembourg by the CSSF, where we have a payments institution license. And in Europe and in other parts of the world, Ali, there hasn't actually to date been specific regulation for crypto firms, but that is changing. That's changing in Europe, it's changing in parts of Asia as well, it's changing in North America too. So one of the things that's happening in Europe is the virtual asset service provider licensing and registration regime. So this is a regime that is built around the money laundering rules. So anyone offering a crypto in the European market is subject to these requirements in each local European jurisdiction. So we are licensed not only now in Luxembourg, but also in the UK by the FCA as under that regime, which is the Virtual Asset Service Provider regime, or VASP. Also about to be licensed in the Netherlands by the DNB. And we're embarking on the licensing process for Germany. Each country, actually, Ali, in Europe has a slightly different regime, and you have to be regulated in each one. In North America, we have MTLs, which we have to have across each state that we operate in, but also in New York, there is something called a bit license, and we hold a bit license in New York to serve customers in New York, where obviously a big proportion of customers sit on the institutional trading side. And these are some of the biggest firms in the world that are trading any number of markets that you might think of, not just crypto. And these firms entered the space, maybe 3 or 4 years ago, or even 2 years ago, to add cryptocurrencies to their trading book alongside equities and commodities, etc. So that's how we're regulated. And what we see happening as well, on that one, just to mention, in Asia, we are in the process of obtaining a license from the Monetary Authority of Singapore as well. And Singapore is where we have one of our operations. And actually the Asian market as a whole is one that is growing, with hubs in Singapore, Australia, and Hong Kong, primarily, where a lot of institutional firms are. But really, that institutional interest is growing globally, including in Asia. So we do see, actually, Ali, regulation increasing through the world. In Europe, it will evolve to a MiFID framework of licensing, which is called MiCA. MiCA is scheduled to come into play in 2022. Thereabouts is what the European authorities are saying. So any firm that's trading crypto or working in the crypto markets will be subject to that regime. And in the US, even just this week, actually, Hester Pierce, the SEC commissioner, made a speech on atomic trading on Monday, I think, where she gave some very open comments around how, from her perspective at the SEC, she views regulation should be evolving to embrace the technology, which has a lot of benefits for society, and is obviously popular with the people, and so needs to be managed in a way that allows that technology to flourish without restricting the freedoms of the people that it's supposed to serve. So there is quite a, I would say, pace of evolution that's happening globally with the regulation, and an understanding of what actually Bitcoin is, and how that could fit into our societies in a structured and orderly way.
Thank you. That was extremely insightful, and I learned a lot. I wasn't aware about of these new regulations which are coming in, but as you have pointed out, it seems as if the thinking on the regulatory side is fairly advanced and their licenses are already out. Can you give us a sense of the scale? So how big is Bitstamp? How much volumes do you do per day? How many number of investors, retail versus institutions?
Yeah, I can certainly do that, Ali. Last year, and these volumes are, you can check our volumes and all the exchanges and the markets through sites like Crypto Compare and Masari. All our daily volumes are there in the market volumes. Last year on our platform, on our exchange, $77 billion was traded with us. This year, we expect to exceed that by at least double and maybe even more than double. The volume this year has increased significantly from last year, and it's not just Bitstamp, but all exchanges are seeing this. You mentioned Coinbase, who is another one of the big exchanges in the market. They are IPOing soon this year, and the NASDAQ market pre-price is over $300 a share, which values them anywhere between $77 to $100 billion and maybe more. And so the market here, also you mentioned Bitcoin. Bitcoin the other day did hit $1 trillion market cap. That's just under half the size of Apple. Various folks, Pantera are predicting a price of Bitcoin at $115,000 by August of this year. And so if that were to happen, then we're talking about a $2 trillion market cap. So Bitcoin being a similar market cap to Apple. And so, what you have happening here is, a revolution in a way, in that it's Bitcoin is now becoming established as its own system into which capital is flowing, and obviously making up that market capitalization. As one of the largest exchanges in the world, we are uniquely suited to serving institutions, given our liquidity and given our depth of order book. And that's one of the reasons institutions come to us and connect to us. You mentioned Revolut, others such as Swissquote, Börse Stuttgart in Germany, and many large companies connect to us to access the cryptocurrency markets.
Chris, before I jump to Mohammed to get his views on the pricing and the valuation and why institutions are investing and what's the investment case for this, I have one more question. That when you deal with these regulators, especially now, what's their attitude? And similarly, when you deal with institutions, what's their attitude? And how do they get comfort with the processes for KYC, AML, which you have? Or rather, let me ask it more bluntly or straightforwardly. People think that Bitcoin is anonymous, and because it's anonymous, you cannot keep track. It can be used for money laundering.
Yeah.
Is that true?
Yeah, it is let me say it's a common misconception. And I'll explain it like this, and then also answer your question on the regulator. Bitcoin is within the Bitcoin ecosystem, you are pseudo-anonymous, but you're not completely anonymous, because everything, all transactions are on a public blockchain. We can all, with an internet browser, look at all the transactions that happen on the blockchain network. So it's not hidden in that sense, say like it is on a private network, and some of the world's payments networks are effectively private networks managed by counterparties and third parties. But that's not the case on the blockchain network. It's all visible. And if you trade on a regulated exchange like Bitstamp or any of the other regulated exchanges, you are not anonymous, because we perform KYC and AML checks on you. And those KYC and AML checks are the same kinds of checks that a bank would do or any other financial institution. And they have to meet the standards of the regulator. So for example, in the UK, That's the FCA money laundering regulations under the 5th AML directive. We are subject to those in the same way that HSBC is subject to them, in the same way that Barclays is subject to them, in the same way that Deutsche Bank is subject to them. We have to follow exactly the same regulations and report to the regulator. We also have a duty of regulatory reporting to the CSSF in the same way that a financial institution would for suspicious transactions. We report both suspicious fiat transactions and also suspicious crypto transactions. Now, one of the things in the cryptocurrency world, Ali, which we have, which you don't have in the fiat world, is that there are now tools available to us players in the market, and it's used by our compliance and transaction monitoring teams. We can use tools like Chainalysis and Elliptic, which also the regulators use, to monitor all transactions for the cryptocurrencies that come onto our platform. So when a customer opens an account with us and deposits Bitcoin, we use those tools to trace exactly where on the network it's been. And we have a complete map. We can see where it was mined, what wallets it's been through, and anything that looks suspicious is rejected and terminated, and can also lead to reporting to the authorities, up to and including police authorities. And this is true across, all regulated exchanges. So the notion these days that it's anonymous, and the notion that criminal activity happens within this world is no longer the case. Certainly at the sort of dawn, that we say, of the start of the Bitcoin world, perhaps that was the case because there were no controls in place. But that's now not the case at all. And in fact, there's a few reports out there. Chainalysis have reports on their website. CipherTrace have done a report recently which shows that the actual amount of illicit activity that takes place on the network is extremely low in comparison to the existing banking network. And so there are many controls and many practices now in place that have moved the Bitcoin network and the cryptocurrency world into one which is now more highly regulated, now more open to being policed, and certainly is monitored very closely by the regulated exchanges that operate in the market.
Thank you, Chris, for giving us so much information on this extremely important sub-question, which perhaps still is the first question which I get. And as you rightly pointed out, almost by definition, because the ledger for Bitcoin is a public ledger, it should be more transparent. And the funding part, as you said, like now it's getting, you are complying with almost the same rules. If you are complying with the same rules which any financial institution would comply with. And because it's digital, even theoretically, digital should be more transparent and more trusted compared to something which is analog and cash. Moving to Mohammed. Mohammed, you invest in this asset category. And of course, you have invested in equities and global markets. Why did you do this shift from investing in global equities to investing in this asset class?
So first of all, thank you so much for having me, Ali. It's a pleasure to be here. I've done one CFA Society event here in Dubai, and this is my second one. And similar to the event in Dubai, the questions were of very high caliber, and I can see in the chats, questions are coming in. And that just goes to show of the quality of people that are here on this event today. To answer your question, why did I do the shift? I agree with you that I always had this slightly controversial or contrarian attitude to assets, basically. A good example is what you mentioned in the beginning. Coinbase is a cryptocurrency exchange that is operating in a highly competitive environment together with smart guys like Chris and his institution. And the valuation that is currently being put on this is a multiple of what you would have for comparable brokerage accounts and companies that are doing a similar service, let's say, on the equity side, which is a very traditional asset class, highly developed and sophisticated. So you know, if it were again to your analogy, so to say, I'm not sure I would get that excited about that 100 billion valuation, basically, right? But that's, you know, the jour of the day, and that's not, it's not for me to judge. I'm not giving financial advice on this call. I'm just merely passing on my personal views. To answer your question, in 2017, I was not as lucky as you are, by the way. I wasn't introduced to Bitcoin in 2011. I only got involved in 2015. But for the ones that know the prices well, it was actually lower than the price that you mentioned in 2015. Given, like Chris mentioned, the nascent development at the time of the industry. And in 2015, when I first heard about it, I knew that, immediately knew that I need to spend time on this, that this is something extremely interesting. As a fund manager, as a portfolio manager, the number one worry that you have always is, you always think of what can disrupt my portfolio. Where can I be wrong on those companies that I own? You know, what can come up in terms of as a technology that can destroy the value in some of the equities that I have invested in. So you always look at technology more of a disruptor to what you already own. So I was always trying to follow what's happening in the markets generally from that perspective. And when I got to know it in 2015, I knew this is something interesting. In 2017, to answer your question regarding institutions, I was at a conference in London on the panel with one of the colleagues from CoinShares, actually. And someone asked that question about, you know, it was actually, the topic was institutional highways opening for cryptocurrencies. And in that conference, I basically said that, you know, it's way too early. They are not there yet, but, you know, the highways are being built and those institutions would come. And when I said that, one of the senior fund managers who was sitting in the front rows shouted out, actually, without the microphone, he shouted out and he said, "We don't need it and we're never going to buy it." So, so that was 2016, 17, I think, early 17. And now fast forward 4 years, like you said in your introduction, you know, all those fund managers that have been shouting, you know, we don't need it and we're never going to buy it, are now trying to look for ways of how to get involved in this asset class, because like Chris said, we passed $1 trillion. And now it's become, you know, it's happened in 12 years, right? It took Microsoft 46 years, if I remember correctly, or 44 years to cross $1 trillion. Although the two are not comparable, obviously. One is an equity value, the other one is an asset class emerging as a property, right? Not necessarily, there's no equity value in Bitcoin, basically. So what I would say certainly is, in 2017, when we were sitting on the panel and arguing that institutions are going to come, we were basically pipe dreaming. And whereas now in 2021, when I say the same thing, I'm not going to say institutions are coming. I would say institutions have arrived, and they are increasingly getting involved, basically. So that's a very different situation. Now, for every CFA member that is on this call, I won't say that, like in 2017, you have the luxury not to do the work. In 2017, you could have died. You had the luxury to not be involved, to not do the work, and maybe ignore it. And maybe you'd be lucky you didn't have to learn anything new, and things would have stayed the same, right? But I think now you don't have that luxury anymore, unfortunately. Now, I think every individual, especially individuals that are involved in finance, that have this title, are forced to look into blockchain technology, especially DeFi, decentralized finance, which I believe is a new phenomenon that has now arrived, similar to the 2017 ICO boom, with a big difference that the ICO boom was basically a fund management mechanism that was not sustainable, whereas DeFi is actually a development that is very, very sustainable. And in my personal view, and this is another prediction, like I've been doing in the past, that is going to disrupt the financial industry, basically, very, very significantly. I don't believe that anyone in this channel even, mostly based, I assume, in emerging markets, within 10, 15 years, will be depositing their cash with human beings. I think they'll be depositing their cash with the software that is run decentralized, where, you know, depositors and borrowers are being run based on the software and the collateral on both sides, basically. So I don't want to talk for too long. I don't know how many questions you want to answer, etc. But I think overall, my message is for all the guys that haven't done the work yet, I don't know the background of the individuals on the call, but my message is, even if you don't like it, look into DeFi, look into blockchain technology, especially decentralized finance, because that's the part that's going to affect you, basically. That's the part that's definitely going to affect you in your day-to-day job, basically. So that would be my suggestion or recommendation.
Thank you for that, for making us realize how important this is. And unfortunately, and you're totally right that now it's becoming a part of academia, and CFA Society has published a paper on it, which we are going to discuss. But unfortunately, I feel that in Pakistan, we are a bit behind in terms of the learning of it, because it is still banned. Pakistanis cannot buy it, but also companies cannot, like I recently set up a company, and I had to give an undertaking that it will not be working in anything related to Bitcoin, just because the name of the company had block in it. So they said block name sounds suspicious. So I had to give an undertaking on a stamp paper that I will not be doing anything. But hopefully that will change. Going to the questions, because the questions are asking about the thing which you alluded to, Mohammed. So the first one is they're asking that, what are the key catalysts that drive Bitcoin price? And is Bitcoin an alternative to gold? Does it have negative correlation? How should we see it? Should we see it as a currency, equity?
So I want to refer, I have a YouTube video where from 2018, I think, early 2018, where the title is the new, in brackets, the new digital gold. So I was actually one of the earlier proponents of arguing that Bitcoin is digital gold, when a lot of other people were arguing whether it's currency, whether it's money, whether it's property or something else. I always was focused on the property of Bitcoin as digital gold. I really believe it's digital gold. Human mankind is always been using money, whatever is the hardest form of it, right? If you look at the history of money, you can see that very clearly, and relatively quickly, human mankind has come onto gold. And the reason why human mankind has used gold is because it was scarce, it was democratically available, so to say. It had unforgeable costliness, so you couldn't fake it. You had to basically either mine it or pay for it to buy it. And it was, widely understood in terms of its qualities, and you couldn't get rid of it, right? You can melt it, but it doesn't. You can't get chemically. You can't get rid of it, basically, right? It's always going to be there, so to say. So that's why gold has established itself as the hardest form and has become money. Now, for the first time in human history, 11, 12 years ago, to be exact, on 3rd of January 2009, after the white paper had been established and distributed by Satoshi, the first Genesis block was formed. So on 3rd of January 2009, human mankind has basically found a harder form of money, harder than gold, because the stock-to-flow ratio, or in other words, the inflation rate of Bitcoin, is actually at the time, right now, on par / slightly lower than gold. And by 2024, given the Bitcoin protocol halves every 210,000 blocks, which approximately is 4 years, it will be half the inflation rate of gold. So from 2024 April onwards, Bitcoin will be double as hard as gold is, so to say. It means it's going to be double as scarce as gold is, while still it's transportable and highly divisible. So this is just a harder form of money, and therefore it's quite natural for human mankind to basically move towards this new form of money and this establishing itself as digital gold. So for all the people that get on this call, instead of making things very complicated, it probably would make sense to focus on the digital gold aspect first and really get your head around that first, which basically will force you to read the Bitcoin Standard from Saifeddin Ammous, which probably is the single best book on Bitcoin and hard money, Austrian School of Economics out there, basically. And then once you've done that, I think then a lot of things will become much, much clearer, basically. In terms of the pricing of it, just to answer that part as well, in terms of valuation of it, if you think of it as gold, then most of the people here, depending on how much work they've done on the commodity side, Ali, from your history on equity research, that generally commodities or precious metals are priced on the marginal cost of production. And overall, you can see that Bitcoin has been oscillating around the marginal cost of production, with large swings though, because of these big pushes when the community starts growing, right? So, I mean, one of those pushes we are now seeing over the last 4 or 5 months, basically, mostly driven by the stimulus and the money printing by governments, right? So overall, that marginal cost of production for Bitcoin, because there's a shortage on chips at the moment, is approximately 17,000, 18,000. I would expect that to arrive to $60,000, $70,000 by the summer of this year, and north of $200,000 by 2024. So, and that's just from the halving. And you can do these calculations. A lot of material is on the web. When people Google about these things, they can see these things, and you can price them on TradingView. There's all sorts of information on the web on these things, basically. But that's what I would take as a guideline, the marginal cost of production, basically. But there is many other methods that you can use. But I'm just saying, using the established equity research model from the banking side is probably using marginal cost of production.
Thank you. You've already answered the next question, which was on valuation methods. And when you were talking about digital gold, it reminded me of a presentation I heard from the Winklevoss twins at Money 2020 in 2015 at Vegas, where they gave a very detailed presentation on why did we end up as gold as a store of value, as a store of currency, and why this digital currency is better than gold on the same matrices, which led us to select gold. So I'll highly recommend it to people on this call. If you can Google for Winklevoss presentation, Money 2020, I'm sure you'll find it. I think they run a fund, and it's also on the website of their fund. Moving to a question to Chris. So we are open for questions. Please write it on chat. A lot of people have asked the questions already. There are 133 participants. I'm sure we won't be able to take all the questions, but we'll try. Chris, some people are asking about the exchanges which we have spoken about. Are they connected? And secondly, I think you've already answered this question, but what about, how would you rate the ethical standards of trading? I mean, is there any manipulation of this asset class, which leads to this kind of volatility which we see in the price?
So yeah, to answer the question on the exchanges are not actually connected themselves, but exchanges do get connected through brokers and through smart order routers and such like. So between the big exchanges, we, let's say, don't have our own network that connects us. But it is possible to buy Bitcoin through a broker, or some companies are using smart order routers that will send the order out to the market. The market consists of the big exchanges, and that order ends up executed on best price, best execution at the time. So there's interconnectivity that way. And then in terms of, the question on trading. So the big exchanges like Bitstamp, we have market intelligence teams that do watch for market activity. And if we do see any suspicious activity from a trading perspective, we investigate that and take action with those trading clients. So it's a lot more mature, Ali, than it has been in the past. And we definitely see that kind of maturation continuing as well. And we've talked about Coinbase and their IPO and such like. I suspect now that one of the topics that will generate is a whole discussion around market infrastructure and the exchanges. And we already know that the traditional exchanges are already exploring the space. Some have already entered it. So over the next, period of time, not sure, let's say over the next 3 years, definitely see some, changes happening in infrastructure where, certainly from a market infrastructure perspective, we'll see maybe some of the bigger players coming in, maybe some exchanges joining together.
Thank you. And Chris, also, can you give some insights into the audience into the other capital market infrastructure which now already exists, which is enabling this? So, for example, there are investment banks which offer custodian services, which offer lending services, which offer trading services, which has enabled these institutions, and then companies such as yours, which have enabled institutions to participate in this with comfort.
Yeah, I think, it has been for some time that, the bigger institutions, traditional institutions, have not participated in the market for a number of reasons, but that's changing at pace. And we've seen, announcement recently from various banks, for example, that are either exploring or launching custodian services. So BNY Mellon is one, Deutsche Bank is another, Nomura is another, DBS in Singapore are launching an exchange. And, we see this now happening across the world. And, the truth is that the institutions best placed to be the custodian for Bitcoin are the banks. The natural sort of place for a bank in this ecosystem is to be a custodian because, banks already custody our assets for, cash, gold, other assets. So why not Bitcoin? And Mohammed's really explained it extremely well and summed it up very well indeed as to where Bitcoin fits in and its role as an asset class now, and that's firmly in place. And I'd also echo, from an understanding perspective, the Bitcoin Standard book is the book to read to understand why this is. And I think what we see now happening, Ali, is banks do understand now that this is a market that their customers are asking them for. We have some of the biggest banks in the world now approaching us and asking us how we can serve their corporate clients initially. So these are some of the biggest corporations in the world that are talking to their corporate banking team, asking them whether, how they buy Bitcoin, how they acquire Bitcoin, put it on their balance sheet. And the banks have no capability to serve those clients presently. And so they're in discussion, and I'm sure it's the same with the other exchanges, they're in discussion with us to see how that can happen. So as this grows, we would expect banks to participate more, for perhaps it's custody being the first step. And then the next natural evolution is for allowing their customers to exchange from within the custody solutions. And that's probably the next step that we see happening from a traditional financial capital markets perspective.
Thank you. That's very, very interesting. So essentially, you're saying that all the large banks are now looking into developing products for their customers to support their customers to engage, to invest in this. Again, very, very different from in Pakistan, because I don't think that the banks are there yet where in their understanding of this. There's another question slightly on a slightly different topic, which is central bank currencies. And I want to ask two questions. First, Mohammed, I know you have an opinion on how central banks should view this. And then I'll come to Chris, because given your previous company, I know is working a lot on this. So I'll ask you after that. So first, Mohammed, what's your take on how should central banks view this space?
So are you talking about central bank-backed digital currencies, or are you asking me what central banks should think of virtual currencies?
Exactly. I'm asking you, deliberately asking you the broader question. There is central bank representatives are on this call. So I want to ask you first the broader question that what do you recommend? How should central banks in emerging markets such as Pakistan, how should they look at virtual currencies, both as an asset class and secondly, also from how can they use it for money transfer and things like that?
Yeah. So basically, first of all, let's categorize so that we know we're talking about the same things. First, Bitcoin is digital gold. That's what we're discussing. It's very clear. It's got the largest network. It's got escape velocity, 150 million users or people that are storing value on this monetary energy network. So it's very clear. It's already established itself as digital gold. It's already 10% of the gold market in terms of value. It's probably going to get there approximately to the 10 trillion value, which would then be already replacing gold as digital gold. By the way, the same has happened in the past. Gold has replaced silver, which is why if you look at the gold-silver ratio over the last 100 years, it just goes one way, which is down, because gold has eaten the monetary value of silver, basically, out of it, right? So that's the first. Secondly, you look at all the other virtual currencies, there's a couple of base layers, such as Ethereum, maybe Cardano, which is still an experiment, maybe Polkadot, which is still an experiment for the DeFi network, etc. Those could be base layers, so they have a utility. And then there's a lot of venture capital type investment opportunities that are governance tokens, utility tokens, security tokens, etc., where you can bet on some specific team being able to achieve some specific task, and if you're right, you might make money, basically, right? But be careful. You better check what you're investing in, because not everything, is not an equity value that you're buying. So you need to make sure that either they do buybacks, token burns, or all sorts of things to give back from their success to the token holders, basically. So that's the general category. When it comes to central banks, for me, central banks should look at it two ways. And I just published an article at The Independent regarding that. I made a prediction. I said within the next 3 years, I expect one emerging markets central bank be the first to add Bitcoin to their foreign currency reserves. So as you guys know, the largest holders of gold globally are the central banks. And by a vast majority, they're the largest owner of gold globally. And my prediction is that, fast forward 20 years, the largest owners of Bitcoin are going to be the central banks, basically. So my prediction is in the next 3 to 5 years, one forward-looking central bank will be the first one to see Bitcoin as digital gold and basically do what its citizens are already doing: store value in the digital cyberspace bank, basically, right? And that's what their citizens are doing to protect themselves from the devaluation of their local currencies. And my prediction is that one emerging market central bank will follow that and will do that. My other prediction related to that is that the market will applaud that central bank. So whichever central bank is going to do this first, you'll see their bond yields collapse. You'll see their currency strengthen. You'll see their equity market roar. Global bond investors, equity investors, institutional investors will see that central bank professionals as highly forward-looking individuals that are going with the time, that they are understanding the changes that are coming upon us, basically, right? That's my prediction. Separately to that, I would expect central banks to come up with their own central bank-backed digital currencies. Now, why is that? It came very timely. Last night, for around 6 hours, the Federal Reserve was down. You couldn't make any payments. I mean, Chris will know this very clearly because those guys get affected, or any payment processing company gets affected. You couldn't make any payments. You couldn't do any ACH. You couldn't, no interbank, nothing was working. All the systems were down because of some internal glitch. Over the 12 years of operations, you never had this on the Bitcoin network. We have 99.9998% uptime on the Bitcoin network, on the Bitcoin blockchain, basically, right? So again, what I would suggest to central banks is forget the centralized networks, come up with a centralized blockchain, so you're not dependent on SWIFT, where you can actually transact 24/7, 365 a year, and at the same time control up to the wallet of all the individuals. So it helps massively on monetary policy. So you can actually do very targeted monetary policy because you can see all the wallets basically in your country. And at the same time, you can be much more efficient in terms of understanding where velocity of money goes, where issuance is, etc. So it's just a much more efficient system for any central bank to do. It has a side benefit to it that you're not reliant on the SWIFT network anymore, which is why China is probably the leader in this, as the big guys that can basically stand up against our brothers in the US, basically, right? So, but that's more the geopolitical side of CBDCs, basically. That's, I think, all I would have to say on this topic.
Thank you, Mohammed. Chris, what are central banks doing? I know your former colleague, Steve Kirsch, is now working on this a lot. He's advising central banks. For those who don't know, Chris used to work with Steve Kirsch, who made the optical mouse, which we all use on our computers. And now Steve is working, advising central banks on how should they use crypto. So Chris, can you give some insights on that?
Yeah, happy to do that, Ali. I'll also actually just quickly agree with Mohammed on on his prediction that we will see this. I may even go one step further and maybe even just stick my neck out and just guess on which nation that might be. You know, my bet is Switzerland being the first one. Actually, radical suggestion, but the Swiss are very, very much ahead in their thinking around crypto. And so I would say to just keep an eye on what the Swiss are doing. But this is true. I'd also say on that as well, you know, Mohammed mentioned a couple of projects, Cardano and Polkadot. There are these projects emerging in the DeFi space, which have the potential to go beyond Bitcoin if these projects work out, because they're effectively the upgrade to Bitcoin. They bring in smart contracts and other things. And, you know, one of the questions circulating is which nation potentially is going to build a new monetary system on one of these new networks and protocols that are emerging. I think this is something for the future, but really something interesting to look at. To answer your question, Ali, in terms of what central banks are doing, they are all investigating how they you know, go about launching their own CBDC. They are working with companies that you mentioned, Steve's company, you know, M10. They have a technology platform that allows central banks to be an issuer of CBDCs, and their platform and network, you know, helps them do that. I think, you know, it'd be fair to say as well that, you know, while central banks are looking at it, there's still a little way to go. You know, there is an impact, you know, in a couple of ways. One is technology-wise, which way do they go? Is it token-based or account-based? And then, you know, how does this interact with the existing banking infrastructure? So whilst the central banks are going down this path, the really interesting thing, I think, and the point that Mohammed raised really is, you know, which nation will actually, you know, choose Bitcoin as the new standard. And then that takes us into a new realm altogether. So I think two parallel things happening, and which one will happen first?
If I may, Ali, I want to just point out one thing that I saw in the questions that's come up a couple of times, which is the volatility of this asset class in general, and probably Bitcoin in specific. I think this is coming out since I've basically joined this space, I would say, or been interested in this space. And I actually don't understand that criticism, because it's never been an issue for me personally. And the reason being, and maybe that's because I come from a traditional fund management background, basically. But the reason being is in every new technology, you have what's called the S-curve, right? The adoption curve. And we all know this, right? In the beginning, you have the early adapters and the innovators and the early adapters. And then, you know, from then on, it goes into the up all the way until the late laggards, basically, what you would now call the boomers, who would then join some sort of technological change or shift, right? And there, it's very clear in the S-curve that volatility in the beginning is always very high. And as the asset or the use of that technology develops, you know, the volatility becomes very low, right? The volatility of the members, of the number of members 10 years ago on Facebook was humongous, right? I mean, every week, every month, there was whatever, 15, 20% user growth. And now it's probably 4%, 3%, 5% a year, because already 2.5 billion people, 3 billion people are already on the network, basically, right? It's very similar to this. When gold left the gold standard in 1971 at the famous Bretton Woods conference, I mean, Chris will know this, over the next 10 years, gold was up and down 10, 15% a day, basically, when it finally decoupled from the dollar. Why? Because people didn't know, what is it worth? Is it going to get banned? Is it going to be allowed? What is this asset floating that is not a government? It has not an IOU. Who owns this? Who is in control? All these questions that are coming up on the chat were things people were asking themselves in the 70s and in the early 80s. for the same reason for gold, basically, right? Now, 40 years later, gold has established itself. It's a known asset class. It has still all the issues that you mentioned in the beginning of KYC, AML, blah, 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 all the other issues. But it's a 10 trillion asset class that millions and billions of people are using it as a store of value, basically. And its volatility is down to what? 1.5% a day max, and maybe whatever 10-12% annualized, basically, right? And that's what's going to happen with Bitcoin when you give it time, because the community at the moment is only 150 million people. But let first 1 billion people buy, sell, trade, be invested in this asset. Then you'll obviously exactly the same will happen. The more eyes look at it, the more the volatility will come down, and it won't be an issue anymore. So dismissing it for the sake of volatility that's just wrong, basically. That's just not seeing the woods, from the trees, basically, right? Focusing on the tree and not realizing where you are in the woods, basically, right?
Absolutely. That, certainly volatility makes people attracts various kinds of opinions. And of course, as Mohammed, you said earlier, that our purpose over here is not to preach people to buy or sell something. Right. We're not giving investment advice. We are just discussing. So this is not we're not preachers of telling people to buy a certain currency or not buy a certain currency. We are just discussing the facts that as you said, that this is a part of finance now, and universities, LUMS is going to teach a course on it. So somebody who wants to learn can go. And CFA Society has published a paper which we'll be discussing in 6 minutes time. I noticed that Matt is already on the call. So it's more about just discussing what the facts are. And it's a fact that the largest asset management company in the world, which manages trillions of dollars, BlackRock, is now offering it to its customers. Fidelity, another $1 trillion plus asset management company in the world, its CEO is recommending people to invest 1% of their holdings in it. And certainly I would expect that they are conscious of the volatility, I'm sure. But just like you said, in terms of the S-curves of adoption, certainly people's risk appetite is very, very different. And sometimes it's also a function both of their knowledge as well as the amount of money they have. And often people who have the lesser amount of money, for obvious reasons, are more conservative. So, I personally never have the patience of arguing with people on investment advice. But hats off to you. I don't have that kind of patience. I would also recommend a few books. Bitcoin Billionaire is a great story. It's easy read, which tells, I think it's a good read, which tells in terms of the journey of how it has evolved over time. And to your point, Mohammed, in terms of the volatility, it gives examples of currency. If you are from Argentina or Turkey or Cyprus, you would actually find that your own currencies are far much more volatile and far much more unstable. And in my day job, I pitch Pakistan to fund managers such as you, Muhammad, and other international fund managers. I can tell you that it's difficult to sell Pakistan for the same reasons that they say it's too volatile, too compliant, too uncompliant. Can I even go there? That it is it's selling Bitcoin. It's much more easier to have a conversation on cryptocurrency than it is on Bitcoin. So, but locally in Pakistan, of course, it's a different world. So, of course, people's perception of risks vary. Let me look at somebody's asking, Mohammed, can you repeat? Chris and both you and Chris recommended this book. Can you repeat the name of that book?
Yeah, I'm just going to paste it into the chat now. It's called,
Ali, I've seen an interesting question. Sorry, go on, Mohammed.
It's called the Bitcoin Standard. I just pasted the Amazon link.
That's great. Chris, you want to pick up on something?
Yeah, I just thought Faisal asked a very interesting question. What stops anyone from launching their own version of Bitcoin like Chris Coin? So it just caught my attention. Thank you for the question. Actually, there's nothing stopping you. Some of the newer networks, Mohammed mentioned Cardano. Actually, the next iteration of Cardano, you'll be able to utilize the underlying ADA token to build your own token. So there are kind of networks and protocols out there that potentially we could see people launching the next version of Bitcoin. So yeah.
Thank you. I think we have run out of time now. Muhammad and Chris, it was a pleasure to talk to you as always, and I always learn a lot. And the thing which impresses me the most with Muhammad is how eloquent he is. Like, he's very precise with his answers, and he covers a lot of topic with a very little amount of words, which always is a sign of a very smart person. So thank you for your time. We'll move on to the next discussion, and some more people to educate us on this topic. Matt Hougan and his colleague David Lawant, who are from Bitwise Asset Management, and they have written a paper and on this particular topic, which has been published by CFA Society. And Matt, before you came, Mohammed was saying that now we don't have an excuse or we don't have the liberty of ignoring this topic. And it's a must, especially for everybody in finance and people who are members of CFA Society, to understand what's happening in fintech and to understand what this technology is about, because it will impact our careers. It will impact how finance works. So over to you. Please educate us on how does it work, so that we can better understand, have a more informed opinion, rather than just get swayed by what comes in the press.
First of all, thank you very much for that very kind introduction. Also, that last session was absolutely amazing. I agree with you, extremely eloquent speakers talking about very important issues. And I agreed with everything that was said. I do think we'll see central banks adopting Bitcoin as a reserve currency. I like the idea of Switzerland. I think there will be other banks, including in emerging markets and potentially in other developed markets as well, who will do that. I agree with the comments on volatility. So a lot of what I'm going to say is going to be redundant, but hopefully it will help you understand how we talk about crypto in the US to professional investors who are moving into the space. So I'm going to share my screen and walk through my slides. I'm going to try to do it quickly, because judging from that last panel, the best part of this is going to be the questions. I'd love to dig into the questions, but I will jump into my screen. I will apologize for my colleague, David Lawant. He flew back from Brazil yesterday and had a very difficult, rocky flight to his home in San Francisco. And so I couldn't get him to wake up at 4:30 this morning. So I'm going to cover for him, but my sincere apologies. He passes on his apologies, but he had some travel issues. But let me share my screen, and then we'll get started. I plan to speak for about 15 or 20 minutes, and then we'll move into Q&A. I hope that works. Is the screen up for everybody? Everyone's seeing it? Great. All right. So again, great to meet you all. I'm going to talk about crypto assets from a 101 perspective, and hopefully give you another view of how to discuss them with traditional financial people who are not as used to crypto as maybe the rest of us are. So here's the agenda. I'm going to tell you a few minutes about Bitwise Asset Management, what we do, who I am, where I come from, and then I'm going to reframe how we talk about crypto to professional investors in the US, for whom things like Bitcoin are just now emerging, as was discussed, from the early adopter market to the mainstream market. I'm going to talk a little bit about my perspective about why prices are up so much, and then talk a bit about how I see crypto being used in portfolios by traditional asset managers, what we wrote about in that guide. So first, let's talk a little bit about Bitwise just for 1 minute. Bitwise is a specialist crypto asset manager in the US. We were created in 2017. We today manage over $1 billion. We're best known for having created the world's first cryptocurrency index fund called the Bitwise 10, which holds the top 10 crypto assets weighted by market cap, assets like Bitcoin, Ethereum, Cardano is in there, as well as some DeFi assets like Uniswap and Aave, assets like Chainlink, simple sort of S&P 500 or FTSE 100 version of the crypto asset market. We also offer standalone funds covering Bitcoin and Ethereum, as well as a newly launched DeFi specific fund, the first DeFi index fund in the world. Happy to talk about all of those things in the Q&A box. But what you should know about Bitwise is we've been doing that for multiple years. We manage over $1 billion of assets, and we primarily serve professional investors, so independent financial advisors, hedge funds, endowments, corporations who are looking to access the crypto space. Here's a few of the research materials that we make available for free. That purple one in the middle was the aforementioned Guide to Bitcoin, Blockchain, and Cryptocurrency for Investment Professionals. That came out in January of this year. Just a bit about my background. One of the reasons I wrote that guide is because before I moved into the crypto market in early 2018, I spent 15 years in the ETF market as a CEO of ETF.com. I actually co-authored the CFA Institute's initial guide. It's called A Comprehensive Guide to Exchange Traded Funds. I bring that up because what many people don't recognize about exchange traded funds today, a $7 trillion market, is that for a long time, people looked askance at them. People were skeptical of them. The Financial Times labeled them weapons of mass destruction. The US Congress had ETF providers come to Congress and testify about whether ETFs were destroying American entrepreneurialism and were a threat to capitalism in the US. They were disliked. People were skeptical of them. And then they moved to be sort of the center of way people are investing today. And what I'm seeing in crypto assets today is some of the similar thing. There are many people who are skeptical of crypto assets. There are many people who don't get Bitcoin, who don't like Bitcoin. We're having congressional hearings in the US about whether Bitcoin is used primarily for nefarious and criminal purposes. But one really interesting thing is happening, which is it's following the same pattern of moving from the sidelines to the center of mainstream finance. And I think it can follow the same trajectory, which is one of the reasons I moved from ETFs to crypto assets. All right, enough about Bitwise. I want to talk about crypto. There was a great deal of discussion recently about Bitcoin on this call about Bitcoin as a central bank reserve asset, as a non-sovereign reserve asset, about the book of Bitcoin standard. I want to talk more broadly about crypto. In the US at least, and I admit US bias in this space, but in the US at least, there is a great deal of skepticism about Bitcoin and crypto. I think driving from the fact that people have labeled it a cryptocurrency. And because it's labeled a cryptocurrency in the US, people expect to use it to do things like buy coffee at Starbucks. They expect to use it in the day-to-day lives in the same way that they use cash. And while I think that may be an eventual reality, and I think it may be a relatively near-term reality in certain markets, markets as mentioned, like Argentina and Turkey, where inflation is such a huge issue and people want an alternative currency immediately. The fact that people aren't using it in their day-to-day lives to buy coffee causes people to be skeptical of it. And what we try to do is to reframe it and tell people that it's not a currency. It can be a currency, but that's not what's interesting about it. What's interesting about it is that it is a technology that allows money to move into the internet era. And I like to give this simple slide example. If I were to send my friend David a $1,000 check today in the US and he were to deposit it in his bank, it would take multiple days for him to get the money. His bank would have to check with my bank to make sure that my account wasn't overdrawn, that I haven't written checks, multiple checks on the same deposit. And only after 2 or 3 days would he be able to withdraw his $1,000. What crypto is about is enabling me to send money to David in the same way that I can send a text or an email message, in a way that he can get it today. In the US, there's a service called Venmo. I know it's available around the world as well, that allows people to do this today. And often when I talk about this idea of money moving at internet speeds, people throw Venmo back at me and say, well, you can do it in Venmo, or you can do it in PayPal, or you can do it in Revolut. The reason you can move money instantly in a service like Venmo is that Venmo is a single database. So inside Venmo, Venmo knows exactly how much money I have. They know exactly how much money David has. They control every transaction. So they know I haven't sent my money to multiple people. And as a result, for them, moving money from me to David in Venmo is as easy as changing a line in Excel. Traditional banks are so because there are thousands of databases. Every bank is its own database. They have a record of their own transactions. So if I want to move money from one bank to another, that can't happen until Bank A and Bank B agree on the status of my accounts, agree that it's not overdrawn, agree that I'm good for the money, agree that I haven't written multiple checks on the same account, and only then can money move. The message is, in this case, one bank or one database, very fast, multiple databases, very slow. And the whole way to understand what Bitcoin, blockchain, and crypto is about, the reason we're having this conference, the reason it's a multi-trillion-dollar industry, the reason all the major US regulators that are coming in with the new administration are experts in crypto and blockchain, is it's the first time in the history of the world that we've been able to have one database that's available everywhere. It's available here, it's available in Pakistan, that everyone can see, but that no one single party controls. And that last piece is really important. The difference between Bitcoin blockchain and other blockchains versus Venmo is there's no single party controlling that database. And once you have this new idea, this database that's available everywhere, which everyone can see, but no single party controls, you get three major new primitives, three major technological breakthroughs that we've never had before. And the first is an exponential increase in the settlement speed of financial goods. You guys have talked about this, but the example I give here in the US, if I were to go to Bank of America and tell them I wanted to wire $1,000 to Pakistan or $10,000 to Pakistan, they would tell me that it takes 2 business days, that the fee is 2 to 4%, and I would have to probably go to their office to make it happen. Now, Bank of America is one of the largest banks in the world. It has 240,000 employees. It has a $4 trillion balance sheet. It has offices in 38 countries around the world. And it takes multiple days for them to move $10,000 from here to Pakistan. That's ridiculous in a moment where we can have a video conference discussing cryptocurrency on effectively a free software from here in California. I'm actually on vacation right now to you all in Pakistan. It takes multiple days to move money to 2 days to move money abroad. Contrast that with Bitcoin. The other day, someone moved $1.1 billion on the Bitcoin network. It settled in 10 minutes and the fee was less than $1 US. The fee was 57 US cents. You have an unmanaged network with no CEO, no employees, no offices that can move $1 billion in 10 minutes. And you have one of the largest banks in the world that takes 2 days, or in this case, since it's Thursday, it takes 5 days to move $10,000 abroad, and the fee is 4%. And it's not just money that can move at this exponentially faster speed. It's any financial good. Stocks in the US take 2 days to settle. Our bill pay takes 1 to 5 days. Any financial good can now move at the speed of the internet. The next thing you do, once you allow money to move at the speed of the internet, once you allow money to be native on the internet, is you can program it like software. Now, we're in the finance industry, so some of us might not want to admit this, but one of the curious things is that software and automation has disrupted almost every industry around the world, but it has left the finance industry more or less untouched. You think of something very simple like an escrow agent or a trust agent. All an escrow agent does is sit in the middle of a transaction and apply an if-then statement. If Matt sends money to the escrow agent and someone uploads the property rights across that transaction, well, guess what? Any if-then statement can be programmed in software. And instead of using a relatively high-paid lawyer or escrow agent in the middle of that transaction, crypto allows you to replace that with software that will execute that transaction for pennies. So you can move money at exponentially faster speeds. You can program money. And then the last thing, the thing that's the center of that book, the Bitcoin Standard, the thing that's the center of the concept of Bitcoin as digital gold, is that having the first database that's available everywhere, but which no single party controls, allows you to have digital property rights for the first time in history. And I think this is one of the most major breakthroughs that I've seen from a technology basis in the last 20 years. Prior to that Bitcoin blockchain and subsequent blockchains, one issue with digital goods, they're just a string of letters and numbers. So I can press Control-C, Control-V on my keyboard and create an infinite number of copies. And as a result, you could never own something physically. You can never own a digital good in the same way that I can own this coffee mug, or I can own a painting on my wall, or I can own my wedding band. You could never own it in a way without someone blessing it. You needed a bank to bless the fact that you were the owner of a particular account. You needed a third-party entity to maintain a database of who owns what. The Bitcoin blockchain and subsequent blockchains are the first time we can ever have a digital good that you can own in the same way as you can own a physical good. You can own without the blessing of any independent third party. And that's a very big deal. Now, a lot of people ask me, why has crypto been such an amazing performer, right? Crypto was the best performing asset class in the world last year. It was up over 300%. This chart compares it to other assets like the S&P 500 or the MSCI Emerging Markets Index, the MSCI Developed Markets Index, gold, oil. You can see Bitcoin, or in our case, the Bitwise 10 Index, best performing asset class in the world. It was also the best performing asset class in 2019, up over 90%. It was also the best performing asset class since 2017, up 3,500%. It's also been incredibly resilient, right? Unlike tulip mania or other bubbles, which flare up and then drop down, the Bitcoin and crypto in general has these periods of massive bull markets, significant pullbacks, and then recoveries to new all-time highs. This chart looks since 2017. There's been 30% plus drawdowns, and yet we're up nearly 4,000% over this time period. If you look back further, there have been 70% plus drawdowns in crypto, and yet it's recovered every time. Why is it that this asset has this level of volatility, this level of pullbacks, but is up 43 million% since 2010? And the answer is that this level of technological breakthrough is very rare. So I'm old enough, I'm in my mid 40s, to remember when you couldn't do much with the internet. I remember when all you could do with the internet is send a file. We used to call it FTPing, or file transfer protocol. You could transfer a file to someone else on the internet. That was all you could do. But since 1971, we figured out new things you can do with the internet. In 1982, we figured out how to send text over the internet. Now we all use email. In 1989, we figured out how to send linked text and images over the internet. Now we have the World Wide Web. In 1994, we figured out how to send encoded text over the internet. Before that, you couldn't put your credit cards into the internet. Now we have things like Amazon and e-commerce. In 1995, we figured out how to send voice over the internet. In 2009, we figured out how to stream video over the internet without it buffering. And now we're on a conference call from California to Pakistan talking about crypto. All Bitcoin and blockchain is the ability to send money over the internet. And just like sending text over the internet disrupted the postal system, and sending linked text over the internet disrupted the media and advertising ecosystem, and sending voice over the internet disrupted telephony, and sending video over the internet disrupted traditional TV networks and movie networks, sending money over the internet is going to fundamentally disrupt the finance market in ways that we're just beginning to see and feel. And the reason crypto has had that kind of resilience over the years, as well as the volatility, is this is a major technological breakthrough, and it's not going back in the box. I'm going to check my time here. I want to very briefly, that's my opening thesis. I want to very briefly in the next 3 or 4 minutes just give you a view of why I think crypto is doing what it's doing and what its role is in a portfolio. Crypto is obviously up significantly over the last 6 months. From the US, we see 3 major drivers of that. The first is rising concerns about inflation. In the US, at least, inflation was a distant concern even 2 years ago. But we've seen such extraordinary experimentation with the Federal Reserve's balance sheet and with fiscal policy. US budget deficit exploded from $1 trillion in 2019 to $4 trillion in 2020, and we're about to do another $2 trillion of stimulus. That inflation concerns have moved from the sidelines into the center. They're now at the front of mind for every asset manager in the US. And as a result, people are looking for ways to hedge, and a lot of them are turning to crypto. The second one is the stunning rise of what I call programmable money, or decentralized finance. This chart looks at the amount of money participating in this ecosystem through things like automated lending programs, automated market making programs, automated derivative programs. It's gone from 0 to about $40 billion in the last 6 months. This is the fastest growing industry I've ever seen. It goes under the term decentralized finance, and it's all built on Ethereum and other major blockchains. But the third one, which Mohammed referenced earlier, is that crypto is crossing the technological chasm from the early adopter market to the mainstream market. Even a year ago, most US financial professionals weren't comfortable allocating to crypto because it was associated with criminal activity, because it wasn't an institutional marketplace. It was the purview only of this early adopter market who tends to love technology. But over the last year, it started to make this leap into the mainstream market. And every technology that advances today makes this leap. You can think of the internet in the early days, mostly used on university campuses and by the military, making the leap into the mainstream after the development of email and search engines like Google. And the same thing is happening in crypto now. Just as an example, a few years ago, hedge funds weren't really allocating to crypto. Now it's very common. This is Paul Tudor Jones, one of the most famous hedge fund investors in the world, put 2% of his portfolio into crypto in May of 2020. Not just hedge funds, corporations famously allocating to crypto. Tesla putting Bitcoin on its balance sheet. MicroStrategy buying $2 billion of Bitcoin. Square buying hundreds of millions of dollars of Bitcoin. These are publicly traded companies, members of the S&P 500, concerned about the outlook of the dollar and hedging with Bitcoin. Wall Street, JP Morgan, 2017 called Bitcoin a fraud. 2020, their flagship research report talks about it competing with gold and having significant appreciation potential. The largest asset manager in the world, as was mentioned earlier, now allocating to Bitcoin in its core accounts. PayPal rolling out Bitcoin access to 400 million users worldwide. Traditional retail investors in the US, there are more Coinbase investors, that's the leading crypto brokerage in the US, than there are the 4 largest equity brokerages in the US. There are more users of crypto brokerages than equity brokerages in the US, which is an incredible stat. And in the US, financial advisors increasingly moving in as well. And the point of this is these are all new classes of investors who even a year or 2 years ago were afraid to touch crypto and Bitcoin and are now moving into the market. I want to close with just one word on crypto in a portfolio and then some thoughts on the risk of this market, because I've given a very bullish talk and I think it's important to realize that crypto is still an extraordinarily risky asset. But first, the good news. One really interesting thing about crypto, one of the reasons I got involved in this space is it can be extremely powerful in portfolio settings. So putting aside the technological disruption, putting aside the excitement, putting aside the idea of central banks allocating to Bitcoin or other crypto assets, putting aside the idea even of decentralized finance and programmable money as a major breakthrough. If you just look at it as an asset, it has these 3 or actually 4 characteristics which are really rare to see together. It has high potential returns, right? Past performance is no guarantee of future returns, but the returns to date have been very strong. It has very low correlations with any other asset class. I put on here the correlations to the S&P 500, to the US bond market, to gold, but you can look at any asset class, the correlations are in the 0.1, 0.2 range. And then the last 2 things is that it's liquid. Usually when you're talking about high potential returns and low correlations, you're talking about venture capital or private equity or illiquid markets. This has those characteristics, but is liquid. And then the most exciting thing, it's accessible. So unlike high-end venture capital, unlike high-end PE, I can buy crypto on the same terms as the largest investors in the world. In fact, we have some of the largest investors in the world invested in our funds. We have endowments invested in our funds. We have corporations invested in our funds. And we have me and my father and all the people invested in our funds on the same terms. And it's just so extraordinarily rare that individual investors can access a true alternative asset without liquidity and access issues. And it's really exciting. I'll close with this slide. This slide looks at the impact that this alternative asset can have on a portfolio if it's used appropriately. And I want to caveat that. So what this slide looks at is the impact of adding a small allocation to Bitcoin to a 60-40 portfolio, 60% US stock or global stocks, 60%, 40% global bonds from 2017 to 2020. And what you can see is even a small allocation to crypto, just a 2.5% allocation to Bitcoin, increased the returns of this portfolio from about 50% to 75%. And it did so without significantly increasing the volatility. Now, the reason of that is, of course, it's not correlated to other assets, but there are 2 important caveats here, which I want you to keep in mind if you're considering this as an investment. First, this is only true if you rebalance this portfolio. One of the biggest risks in crypto right now is people allocating to crypto, seeing the price going up and not having a disciplined rebalancing strategy. So this uses a quarterly rebalancing strategy. You can use an annual, you can use a monthly, you can use a percentage-based rebalancing strategy. But if you don't use a rebalancing strategy, crypto has a significant impact on the volatility of your portfolio. So it's very important to consider and use it as an asset and not just allocate to it and let it drive your portfolio. The other thing I would add, and this will be my last comment, is the allocation can, and for most investors, if it's appropriate at all, should be small. Once you get above a 5% allocation to crypto, you have significant impacts on the maximum drawdown of your portfolio. Below 5%, at least historically, equities drive the maximum drawdown of your portfolio, but above 5%, you start seeing a much more dramatic impact. So a small allocation rebalanced regularly has these wonderful characteristics. We have a nice study in that CFA guide that looks on this on a rolling basis, but there's actually never been a 3-year period in Bitcoin's history, despite those massive drawdowns, where it hasn't contributed positively to a portfolio's returns, assuming those things are in place. Before I stop sharing my screen and save 1 or 2 or 3 minutes for questions, I would just add there's significant risks in this market. Of course, this is volatile. Of course, there's still regulatory risks. Of course, there's still adoption risks. But it is an exciting sort of fundamental technological breakthrough. And for that reason, I applaud you for taking some time out of your day to learn about this. And with that, we'll see what we can do on questions. I'm going to stop sharing my screen so I can see all of you closely.
Great. Thank you, Matt, for that very insightful, detailed presentation, which was easy to understand. And I'm just conscious, I just became conscious that you said you're dialing in from California, which means it must be 5 a.m. in the morning for you. So hats off to you. I don't know how you do that. We have 7 minutes for questions, and
Great.
there are a lot of them which have come. There's one question, which is a lot of people are asking for a copy of your presentation. So I don't know if you can share that, or I know you are the author of a detailed paper on this subject as well.
Yeah, absolutely. So it's available through the CFA Institute Research Foundation for free. But after my talk, I'll stay on and I'll post in the chat the link to that, as well as the link to a few other resources that I consider extremely valuable. So hopefully that'll be helpful, and you can download it and read it. Also, reach out with. Feel free to reach out to me directly. I love talking about crypto as well. So I'll put my contact information in there as well.
You certainly need a lot of love to be talking about crypto at 5 o'clock in the morning. So I can see that. There's a question which is that what are the factors which drive the value of any particular crypto coin?
That's great. And I should say about the being from California thing, I find this discussion inspiring. One of the beautiful things about crypto is it is global. And it's a non-sovereign idea. It's an idea that's shared and decentralized around the world. So I find these kind of talks inspiring. So thank you for inviting me in very high level discussion. People talk about what's the fundamental value of crypto. There are two ways to answer that. One way is to think of them as commodities, right? Bitcoin is a commodity that provides a service. The service that it provides is the ability to store value in a non-sovereign sort of box that can travel around the world, that can settle instantaneously. As a commodity, the price of it, which is its value, is just driven by supply and demand. The great thing about that, to get very simple, is the supply is known, right? The supply is fixed, 21 million Bitcoin. We know exactly how many exist today. So the real question is demand. And demand can be influenced by a number of things. It can be influenced by new investors coming into the market. It can be influenced by technological developments that make Bitcoin more useful, right? Can it process more transactions? Is it accepted in more places? It can be influenced by regulation, right? Is it being fostered in different markets, or abandoned or regulated out of existence in different markets? And so the price is really just a function of supply and demand. Now, when you talk about crypto more broadly, it's much more interesting and easy to understand than that. As you get away from Bitcoin, which is the most exciting, most important crypto asset, the largest holding at Bitwise, the other assets are used more as utilities that people find easier to understand. So Ethereum can be thought of as a new sort of financial internet rail, and to use it, you have to pay in Ethereum, right? And there's a significant amount of fees being generated by Ethereum right now. And as you move down the line to things like decentralized finance apps, those are easy to compare, right? Something like Uniswap, which is the largest decentralized finance app, a decentralized exchange competing with the New York Stock Exchange effectively only in the crypto market, is generating, $80 million in fees in a month. And you can almost model that on a discounted cash flow basis. But the right model in your head is crypto assets are a commodity that let you use a service. And as demand for that service increases, you would expect the value of the cryptocurrency to increase. And if it declines, then the value will decline.
Thank you, Matt. There's another question, which is that a lot of the cryptos are correlated with Bitcoin. So how do you hedge from an asset allocation perspective intra-crypto portfolio?
Yeah, I'd say two things. So that is definitely true. They're correlated, but the returns are very different. So they have different betas, different sizes in the market. As an example, we hold the 10 largest crypto assets in our portfolio. The difference this year, since January 1st, between the best performing and the worst performing is over 300 percentage points. One is up 360%, another is up 30%. They're correlated in that they're both up, but the beta is very distinct. The reality is, though, from a math perspective, from a CFA sort of evaluative of the data perspective, historically, there hasn't been much diversification benefit in a broad-based index strategy. And the reason for that is, to date, we're at this nascent stage where crypto is emerging from 0 to 1, and there have been existential risks. And so a primary driver of crypto is whether those existential risks are going to crush the market or allow it to thrive. So as an example, people don't realize this, 5 or 6 years ago, there were no banks that would provide banking services to crypto assets companies, and not for like moving crypto assets. Bitwise was founded in 2017. We're backed by some of the leading venture capital firms in the world, Coastal Ventures, General Catalyst. We all come from traditional companies like Google, Facebook, BlackRock. We couldn't get a banking relationship to pay our payroll because we had crypto associations in 2017. So you had these huge existential risks that could make this industry about, worth nothing. And those overwhelm the fundamentals of the underlying crypto assets, right? Is Bitcoin being adopted more? Is it available in more retail payments? Is Litecoin being adopted more? Is ETH getting more use? Was less important than those existential drivers. The really interesting thing that's happening right now, as we see the fundamental uses of these cryptocurrencies be better defined, right? Bitcoin as digital gold, ETH is this new rail of the traditional financial system, Uniswap as a competitor to traditional exchanges, Aave is this new lending program. You're starting to see those correlations break apart, and you're starting to see something that looks more like, say, the traditional software sector, where yes, Microsoft and Oracle and Salesforce are all interesting companies. They're all software companies, but they have different patterns of returns because they have different utilities. So we're getting past this sort of generalized market to a more specific market, and I expect that to continue and sort of deepen in the future.
Thank you, Matt. Matt, we have run out of time, but I must congratulate you for the work which you have done, because I think this will play a major role in helping this ecosystem by educating people, not just in the US and California, but all around the world, and members of CFA society about how this asset class and how to think about distributed finance. So thank you for your time, and I'll pass it on to the president of CFA Society Pakistan, Muhammad Asim. So over to you, Asim.
Thank you, Ali. Thank you, Matt, for giving us such an insightful presentation. It has been really appreciated by the audience, and we can see the comments already. We really appreciate you being here so early in the morning. So thank you again. We now move to the next session, another exciting session of this conference, the closing session. And for that, we have a representative from regulators. First of all, I would like to welcome Dr. Inayat Saab, who is Executive Director, Banking Supervision Group, State Bank of Pakistan. Briefly introduce about Dr. Inayat. He served as Executive Director of Banking Supervision, and he brings a diversified experience of more than 2 decades. He's a member of Council of Regulators, serves on the Monetary Policy Committee and Financial Stability Executive Committee. He served on as a director on the board of Pakistan Institute of Corporate Governance and Council of Institute of Bankers in Pakistan. He holds a doctorate degree in economics and finance, and he is also a member of CFA Institute. Welcome, Dr. Inayat Saab. We have another speaker from SECP, Ms. Najia Ubaid. She is head of primary market approvals and development department and has been engaged in multiple innovative solutions for the development of capital markets. She has completed her capital markets program from the George Washington University School of Business and Cambridge FinTech and Regulatory Innovation Alternative Finance program from the University of Cambridge Judge Business School. So I welcome you both. I think the momentum has been building on about the opening up of financial ecosystem, and Pakistan, we must appreciate, is a unique market where even the banked and unbanked population is still very huge. A large portion of economy is still outside the banking system. So one can sense the kind of challenges, the issues that regulator has to consider for again opening to something which is again being talked about as potentially can disrupt the financial ecosystem. First, I would like to invite Dr. Inayat to share his perspective in the current stance, and would be really interesting to know how SPP is looking at this subject. Sir Najia, over to you.
Thank you very much, Asim. Very grateful for your very generous and kind introduction. Let me first sort of warn that this session is not going to be as exciting as the previous two sessions. But let me first actually acknowledge very informative and exciting talk by the distinguished speakers. I really enjoyed it. I think I've learned a lot. All the speakers, Chris, Muhammad, Matt, were exceptionally good. They talked really well, and they were all very passionate. So it seemed that whatever they are saying is coming directly from the heart. So very impressive. And Ali was really a great moderator. So congratulations to all, and thank you very much for this sharing their thoughts and information. And let me also thank CFA Institute Pakistan for providing me the opportunity to share some of my ideas and thoughts with you. So I will try to keep it very brief, and maybe if there are any question, we can discuss it in Q&A. I understand that we have we're running short of time. So there are both headwinds and I say and the tailwinds in terms of further progress of the Bitcoin or other crypto assets. So in terms of tailwinds, of course, we are seeing that there are big popular names. They are adding crypto assets in their investment portfolio, latest being Tesla with 1.5 billion of allocation. There are well-known banks that are now providing custodial services as well as trading services for crypto assets. And the acceptability of crypto asset is also gradually increasing. And as was pointed out by speakers, that the Bitcoin market capitalization has just crossed 1 trillion threshold, which by no means is a small achievement. Now, in terms of and let me also acknowledge very frankly that the crypto assets and the blockchain technology in general actually carries a lot of potential, especially for emerging and developing countries like Pakistan, where the other financial infrastructure is not that developed. It has a lot of potential in terms of financial inclusion, in terms of bringing payment efficiency in countries like Pakistan. Okay, in terms of headwinds and the regulatory landscape. Actually, Chris mentioned that he actually alluded to the regulatory framework or structure that is right now being followed, and he also mentioned that they are following more or less the same KYC and AML standards that are being followed by banks. My understanding is that so far the level of regulation on the crypto asset is generally what we call sort of light touch regulation. So I would just, in terms of anti-money laundering and combating of financing of terrorism, will like to sort of point out certain facts. So FATF, for example, in 2014, first time they defined virtual assets and virtual asset service providers, VASP. In 2015, they issued first guidance on the for the regulators on AML CFT prevention relating to VA, that is virtual assets, and VASP, virtual asset, VASP, virtual asset service providers. But the main area that this guidance focused was the intersection points where the virtual assets, they enter into or exit from the traditional financial markets. So it was actually very limited. But then in 2019, the guidance that was provided by FATF, that actually more or less recommended that all the set of recommendations should be applicable, should be applied on the virtual assets as well as on virtual virtual asset service providers. And in the 2020, they have actually sort of again reiterated it. Now, almost as of now, about 50% of the jurisdictions, they are regulating virtual assets or VASPs in some form or other, but it is just the start of the regulation. Now let me give you an example. As I understand the vulnerability in the virtual assets in terms of AML, CFT, and the use of virtual assets for other criminal use. We are all aware of, and especially the people who travel to other countries, that in most of the jurisdictions there is a requirement that you have to declare foreign currency if you are taking foreign currency or with you, if it is in excess of a certain threshold. In most of the cases, that threshold is 10,000 US dollar. The primary objective of this requirement is that any cross-border movement of fund, if it is in excess of $10,000, then it should go through some sort of financial intermediaries. And the financial intermediaries then, of course, are required to conduct KYC and customer diligence to ensure that the funds that are being moved, they are legitimate and they are being transferred for legitimate purposes. And this process is executed both at the sender's end, I mean in terms of the financial institution that is sending these funds, and at the end of the receiving institution. Now, as I understand, the architecture of the blockchain technology or let's virtual assets specifically, because the architecture for different virtual asset is a bit different. So let's take, for example, Bitcoin. In a Bitcoin architecture, the peer-to-peer transaction is very easy. It takes some time, but it can be executed without any check and balance. And as I believe that one of the speakers said, that it is sort of as easy as sending a SMS. So it means that any person, for example, living in country A, he or she can send money to any person in living in country Y without any check and balance. And since the Bitcoin can be used more or less as, for example, cash can be used, or as some of the, for example, speakers mentioned, that the Bitcoin is analogous to the gold. But the problem is that unlike cash and gold, where if you want to, for example, exchange these assets, you need to be in close physical proximity. The Bitcoins can be exchanged, transferred at a great pace. So my own assessment is that as the acceptability of Bitcoin and other virtual currency increases, the regulatory burden would increase, because right now this is a light touch regulation. The reason being that the virtual assets or the transactions carried through virtual assets are actually a small percentage of overall financial transactions. But as these volumes grow, both in terms of number and in terms of size, there would be more and more demand from the traditional financial institutions that are regulated, that the equivalence should be maintained. That is, the equivalent set of regulations should be applied to the virtual assets and on the virtual asset service providers. And when this is done, then at a minimum it would decrease the ease and convenience with which these funds or the assets can be transferred, and at worst, actually, it may require some fundamental changes in the architecture of this whole ecosystem. We are all aware that I'm trying to recall the case of Libra, the stable coin currency that was being issued by Facebook, and we saw that at when they were like at the finalization stage, at the sort of brink of issuing that currency, there were a lot of demands from the regulators as well as the governments insisting that this currency would be subject to the same set of rules and regulations that are applicable on other financial services. And as a result of that, if I recall correctly, actually, a good number of players that were previously on board, they exited because they realized that if the same set of regulations are applied on for example, Libra, that would take away the big incentive or the big competitive advantage that such sort of, for example, stable currency would enjoy. So I frankly speaking don't want to make any predictions. I think there are a lot of good, very intelligent, high caliber people like our speakers who are working in this area. But at the same time, I also see a lot of challenges in terms of going virtual assets or virtual currencies as a mainstay. And I think it's yet to be seen that whether these very high caliber people, very passionate people, they are able to come out with certain solutions. If we can come up with some, for example, technological solutions that can make sure that the transactions can be tracked, where it could be ensured that the transactions that are being executed, the same sort of checks and balances could be put in place, then I think perhaps that could be a workable solution. But as of now, for example, Chris mentioned that it is not an anonymous architecture. It is pseudo-anonymous. But the problem is, as far as I understand, that pseudo-anonymous actually doesn't actually carry any weight. For example, in terms of holder of any other financial asset, you are known, or for example, a law enforcement agency, a supervisor can have access to your information through a regulated financial institution. In case of crypto assets, that is not possible. You can reach to a wallet address, but what is behind that wallet address may never be known to you. Just one more comment. I think we should also take cognizance of this situation, that why in any sort of scam, whether it is WannaCry or whether it is ransomware, invariably the demand is that the payment should be made in virtual assets. And in certain cases where the regulators and supervisors, they have been able to block funds, while they have been able to block funds, in most of the cases, they have not actually been able to retrieve those funds because of the very nature of these. So thank you, Asim. I'm sorry if I took a bit more time than I was.
No, thank you very much. Just one thing, just for the benefit of audience, if you could clarify, what is the current state of the policy on the cryptocurrencies? I understand the financial institutions are not allowed to invest in this, but would help if you could clarify.
Okay, great, thank you. So we have actually issued one advisory and one instructions to our regulated institution, advisory to the general public, where we have warned that the crypto assets, they are highly volatile, they are subject to certain serious risks, and we have actually told the general public in Pakistan that in Pakistan, the virtual assets, they are not regulated either by State Bank of Pakistan or by Securities and Exchange Commission of Pakistan. So if they do any transaction, they will be doing it at their own risk. And in terms of our instructions to the regulated financial institutions, the institutions that we regulate, we have asked them to refrain from dealing in crypto assets, because we feel that the AML CFT risk in these transactions would be very substantial.
Thank you. I have one more question for you, but about the digital currencies. But before going there, I would like Ms. Najia to start the discussion, and would like to ask her perspective with regards to the potential. Again, yes, cryptocurrencies is just yes, one part, one end of the blockchain and the entire technology. How do you see the overall development, and how can it help in the development of Pakistan's capital market and what's happening on this area? James Najia.
Thank you, Asim. And once again, thank you, as mentioned by Dr. Anaya, that this session is extremely useful, and hearing from the perspectives of the international stakeholders, those are involved directly in the process of the digital assets or the crypto assets. So it's good to listen to people, and it's good to have an interactive session. Thank you, CFA Society, for this opportunity. So before moving ahead, I'm supposed to give a disclaimer as being in SECP. So I am giving that disclaimer that the purpose is to educate, and the subject in no way is to invite or solicit investment in the capital market. And again, investments in capital market is a subject to risk, and therefore any decision of investment shall be taken with due care. And the views that I'm going to express are does not necessarily reflect the views of SECP or its employee, although I will not share anything deviating from what SECP in general has accepted or has declared publicly. So now afterwards, moving to the specific scenario of the digital assets, I think we need to understand it a little broader. So when as Dr. Anayat mentioned, that virtual assets have been defined in recommendation 15 of the FATF requirements, and it says that if you want virtual assets to be traded in your country, it needs to be registered and licensed. So virtual assets and virtual asset service providers need to be licensed. Second, that cryptocurrency, that is the digital currency, is the subject of State Bank, and SECP in no form intends to or regulate the cryptocurrencies or even have certain discussion on it. So SECP recently has published a working paper, a position paper that specifies digital assets, and it explicitly provides that it does not cover cryptocurrencies. So when we talk about digital assets, a lot has been explained, and I think my little description would add no value to that. But digital assets can be utility tokens, it can be the security tokens, else than the cryptocurrencies. So we have to broaden the horizon and think of the ways that distributed ledger technology or the cryptographic ledger technology, cryptographically backed assets, can be used in Pakistan. So the position paper basically aims for those digital assets that are not currencies. One of the queries that we generally receive, I have conducted a number of sessions for understanding the perspective of the stakeholders, that what they think of the digital asset. When we ask about the security tokens, what they think. So we have come to know that people think that without a cryptocurrency, a digital asset can't be issued. So it's not like this. A digital asset can be issued backed by a distributed ledger technology, and it can be settled in the fiat currency or in commodity. So it need not to be, technically speaking, settled through a cryptocurrency. So again, coming back to the question that how will and what do we see in digital assets if that is allowed afterwards to be traded as a regulated activity, to be considered as a regulated activity. So the digital assets, what we see can be like, if you see the real estate or the commodities or any precious element that has a value and it cannot be fractionalized otherwise, it can be digitally traded and converted back through the blockchain technology. the ways that the paper focuses are, how do you think, is the regulator expected to do all the due diligence? How will it actually address the AML and KYC concerns? Because we at all points want it to be compliant to the AML requirements. So the position paper questions how will be the secondary and the settlement trading and the settlement and the custody mechanisms that will be handled. So these are the three different areas that have been covered in the position paper. The position paper further also shares and provides the different jurisdictions where digital assets have been recognized globally. It includes Malaysia, it includes USA, it includes Hong Kong. So it includes a number of other jurisdictions. And I have heard that recently digital assets, something is also going on in India as well. So they have actually banned cryptocurrency and they have allowed perhaps a bracket of 6 months during which the investors can liquidate their cryptocurrencies. But otherwise, some development is expected in the blockchain technology area towards the digital assets that can be classified as the security tokens or the utility tokens. Utility tokens are globally accepted and are being done everywhere. So when I say utility tokens, that means that a hospital can issue a utility token and I can utilize it. There is no regulatory framework that bars anyone from doing that. So we have to actually broaden our horizon and understand that digital asset can go beyond the digital currency aspect only. And it can be traded, it can be issued without a digital currency backed by the blockchain technology or the cryptographical ledger technology. And that paper is available on SECP's webpage as well. And you can share it with us at feedback@SECP, your comments on feedback@secp.gov.pk. So this is the perspective that SECP is moving forward on, and I'm open to answer the questions. Thank you, Asim.
Thank you, Ms. Najia. It's really insightful. I would like to add one more question. That would be again about applications in other areas like settlement system, the blockchain technology. Can it really improve the overall infrastructure? Again, can help in increase the investor penetration. But before that, I would request again, coming back to Dr. Inayat Saab. Inayat Saab, I would request again, if you would like to add anything. And secondly, again, further the question about the digital currencies. There are several countries who have started experimenting with digital currencies. I read about China has launched at a very small scale a digital currency, and several other economies. Probably Sweden is considering going cashless by 2023. Again, it's a very small economy and they can leverage on their small scale. But what are the developments and how do you see this area?
Thank you very much, Asim. So in terms of central bank digital currencies, actually, I think last month, the Bank for International Settlement, they are conducting survey, I believe that every year, and the last survey was, the results of last survey were released in January this year. And that shows that most of the central bank across the globe, they are actually exploring the central bank digital currencies. Many central banks, including, like you mentioned, China, they have moved from conceptual research stage to the experimental stage. And we also have a central bank digital currency issued by one of the jurisdiction, that is Bahamas. But a couple of months back, there was another working paper from IMF, and that showed that most of the jurisdictions, while they are experimenting with this CBDC, they do not have, the central banks, they do not have actually the legal mandate. Majority of the central banks, they either do not have the legal mandate to issue CBDCs, or this mandate is simply like not mentioned in their legislations. So most probably there would be some sort of legal, and in certain cases actually constitutional amendments required for the central banks to issue central bank digital currencies. Like all other jurisdictions, we are of course keeping a sort of close watch that what is happening in other jurisdictions. as of now, because the design of central bank digital currency would be very important, and the design would then sort of determine that what sort of impact it would have on the, for example, financial stability, on the monetary policy. So just for example, uh, there is a possibility that if in after the introduction of central bank digital currency and after it becomes prevalent, as in fact one of the speaker mentioned as well, that there could be very substantial outflow of funds from the traditional financial intermediaries. So that could then give rise to the financial stability issues. Similarly, the design of a CBDC can have very serious implications on monetary policy dynamics in a country as well. So I think it is while the countries are experimenting, some of the countries are at an advanced stage, but still a lot of work is required before I think that these countries take, especially large countries, they take the first step and introduce CBDC. Even if they introduce CBDC, most probably they would introduce it first at the wholesale level and then perhaps at the retail level.
We are running out of time, but I would request if we could continue for another 5 minutes. And just one last question again, Inayat Saab, aapse ke, would you consider experimenting opening cryptocurrencies for a smaller market, maybe for institutions, or maybe again to open up it in phases and how it progresses? Do you think this can be the consideration? Just again, a question from the audience as well.
Yeah, the problem is that in fact this on the cryptocurrencies, the instructions that have been issued by State Bank of Pakistan, those have been challenged in Sindh High Court, and it's something that is under adjudication. So I will not like to comment on it as of now, that what would be our future course of action. But it's, as I earlier said, that it's a very tricky area for a regulator. But as I believe Muhammad, I believe, said that even if you don't like it, you should look into it. So that's something that we are actually doing. We are very actively pursuing the developments that are taking place across the globe. And if we feel that there is something that can be beneficial for our economy, for our jurisdiction, then of course we will move towards that direction.
Thank you, sir. We'll now request Ms. Najia to kindly continue on share her views. Yeah.
Yes, Dr. Anayat has rightly mentioned that, again, being in SECP and in collaboration with State Bank, we are continuously engaged with each other, and we are looking forward to the options that will be beneficial for Pakistan's economy. Again, we have to understand the inherent limitation of contract enforcement that Pakistan face. And although FATF is not the major concern, FATF only requires that you comply with the requirements and you actually register and make certain regulatory requirements binding on the parties who are performing the role of the service provider of the virtual assets. It doesn't actually restrict you from issuing the currency or from issuing the from regulating the currency or from regulating the digital asset. It has to make business sense and actually sense for the business environment in your country. So FATF technically doesn't restrict you from performing the rules. The concern is, again, the Pakistani environment, the Pakistani scenario, and we are aware of it. And that's why we have shared the paper where we and State Bank and SECP both are also on a committee that has been developed by the government for evaluating the virtual assets and the virtual currency. So it's all in process.
Okay. Thank you. I think discussion is going so insightful. We would like to continue on, but we are running out of time. So with that, I would like to thank both of you for sharing the candid views. I'm sure our audience have really benefited from this session. And with that, I would like to also thank all our speakers, starting from Chris, who has been really crisp and really insightful and telling us about the overall cryptocurrency outlook and the developments, and again insights with regards to markets. I am also thankful to Mohammed, who again shared very candid views. Again, Matt sharing very insightful presentation and being very generous in sharing the work that CFA Institute has also published. And I'm also thankful to both Dr. Inayat Saab and Ms. Najia. And last but not the least, our colleague Farid Khwaja, who has been a wonderful moderator throughout this session and throughout this conference. And with that, hope we have brought some information and good information for the audience. With that, I would like to take leave and thank you again all. Congratulations to my colleague in the CFA Society who have again gathered all the speakers and brought this arrangement to you. Thank you very much.
If I may add, can we all open our cameras for one last picture? And there's a feedback form if you'd like all of you to fill it up for us. May I request all the speakers to please, and all the participants to please switch on your cameras. Thank you. Thank you so much.